For anyone that doesn't know, what is going on with crypto cards? What are crypto cards and what sort of trends are we seeing?
Yeah, crypto cards are a pretty interesting sort of segment here. I think as stablecoins have been on this really exponential rise, cards specifically end up sort of being this really unexpectedly expected. Cards are pretty easily one of the simplest and most convenient ways for people to use stablecoins and crypto across the world.
I've been following crypto since 2018-ish, roughly. A lot of the situations, a lot of the achievements and milestones we've hit so far in 2026 seem like a distant dream looking at it from 2018. I think it's very often easy to lose track.
My kind of mission for Stable is removing all those asterisks. So if you want to send me $100, send me $100.
My company issued an invoice. The difficulties I had trying to do that, and Hong Kong-based bank just refused to pay it.
There's no reason that you still have fraud on credit cards, but you're still paying high transaction fees.
We've taken all of the systems that your mom used back in the 80s, and instead of coming up with something modern and new, what we've done is just digitalize them.
It's really hard to put that genie back in the bottle.
Hello, today we're joined by Patrick Kim, who is a researcher, analyst, quantitative researcher at Artemis, the crypto data providing firm. Patrick, give me a quick introduction as to what it is exactly that you do.
Yeah, for sure. It's a bit hard to say exactly what I do here at Artemis. I do a bunch of different things, data, research, product, consulting, a few different things here and there. But my most recent endeavor, I suppose you would call it, is the cards report. So.
Cool. Now, I'm very excited about this for a couple of reasons. First of all, I also have a data background, so I'm super excited to nerd out a little bit on the methodology of how exactly you guys managed to measure this. But also, I've been following this space for a while, so I interviewed Simon Jones, who at the time was the chief commercial officer of Banks, which is one of the companies mentioned in the report back in February when they launched the MetaMask card. I've spoken to Corey Sheffield from Visa, who is probably showing this report to his bosses because it makes him look very good. I think this is a space I've been following, and then now there's finally a very comprehensive data report on it. So I want to dive straight right into it. But for anyone that doesn't know, what is going on with crypto cards? What are crypto cards, and what sort of trends are we seeing?
Yeah, crypto cards are a pretty interesting sort of segment here. I think as stablecoins have been on this really exponential rise, especially in the past year or two, especially after the Genius spill in the US and a bunch of other market clarity acts surrounding digital assets and stablecoins. Stablecoins have really popped off. Lots of institutions coming in, lots of other retail users and merchants using stablecoins. And cards specifically end up sort of being this really unexpectedly expected, as I like to call it, natural layer for stablecoins to sort of transact. Instead of forcing, retail users or merchants or whoever it is to set up different stablecoin wallets, you can instead just use a crypto card, which connects to a wallet that you hold, whether that be crypto or stablecoins, whatever it is, and automatically transacts that crypto for you. It can be done in a few different ways. I go into that a little bit in the report. You can, have it such that it sells the crypto on transaction time into fiat. You can have it such that it sends stablecoins natively on VisaNet. There's a lot of different ways that crypto can be transacted through these cards, but cards are pretty easily one of the simplest and most convenient ways for people to use stablecoins and crypto across the world.
Okay, now you guys have a lot of very interesting data, and I want to dive a little bit into the methodology because you guys are reporting explosive growth, and I want to understand how you measure it. But before we do that, let's dig into a little bit more how exactly these crypto cards work. So you mentioned there's various different avenues. Let's try to break it down in an example. I am someone that has a crypto card. I go to a shop, I make a transaction. What exactly happens?
Yeah, so let's say you hold a generic card, something like the MetaMask card, like you mentioned with banks, and you go to a merchant, let's say your local coffee shop, and you want to use your MetaMask card. Luckily, the MetaMask card is already connected to the MasterCard network, meaning any merchant that accepts MasterCard, which is probably almost 100% in the US, your crypto card will work there. Your MetaMask card specifically will work there for certain. And for MetaMask, how it specifically works is, let's say you're holding $100 of USDC or USDT or whatever it is in your MetaMask wallet connected to that card. You walk into the coffee shop, you ask for an iced Americano, you pay $5 with that card. The moment you tap that card, what happens is your stablecoins that you use in that wallet are sold immediately and liquidated into $5 in USD fiat, and then transacted onto the MasterCard network. That way, the merchant is only receiving USD, like they're familiar with, but you were able to use your crypto and weren't forced to, move that off into a centralized exchange and then sell it and then move it into your bank account and then use your Chase card or Amex, whatever it is. You can just use your MetaMask card and make it pretty simple.
Okay, so that's how it works with the MetaMask card, and I understand from the report that there's variations, right? Because it's not always the case that with the MetaMask card, for example, you have the funds in your wallet, which is a non-custodial solution, and the card somehow has like the permission to spend the money that you custody yourself. There's other variations on this, right?
That's right. Yeah, it's pretty complex in terms of what different types there are. For the vast majority of cards that are not issued by Rain or Reap, which we'll go into a little bit later, most of them actually end up sort of just being these bank wrappers. They're program managers for the issuing banks, like Cross River Bank, Lead Bank, whatever it is. And these banks have a pretty long-winded, I guess you could call, interaction with the card. So the way that it would work is, let's say you're holding, again, $100 in USDC in some wallet connected to, call it like a bank's issued card, right? MetaMask, again, we'll use as an example here. And so what it'll do is you'll spend that $5 at an ICE Americano in USDC. That $5 will then be liquidated and sent as $5 into your associated bank account. The moment you create that card account for yourself, it actually spins up a bank account with the issuing bank immediately. So your $5 USDC gets liquidated and gets sent as $5 USD fiat into that issuing bank account, which is then sent off into the MasterCard network and into the merchant's bank. And so it's a pretty complex interaction there. When you use Rain or Reap, it's pretty different. But for most other program managers, that's the general flow that you would follow.
Should we talk about how Rain and Reap work as well? Because I kind of want to understand a little bit the basics of how it works. And then I kind of want to understand why on earth would anyone do this? What's the problem with current credit cards? But first, let's chat about Rain and Reap. What makes them different?
Yeah, for sure. Rain or Reap are what is known as full stack issuance platforms. And so, it's pretty topical with the new Series C round from Rain, which values them at, $2 billion, like almost $2 billion at a $250 million raise. Pretty large raise for what, from a layman's perspective of just a card program. Like, why are they raising so much money? How are they such high value? What is going on here? The reason that I think this valuation is justified is because they are full stack issuance platform. Instead of being reliant on like a banking intermediary or other third-party SaaS providers, they actually collapse the entire stack into their company. And so they own everything top to bottom, basically. There's a few other things that they're reliant on, but for the most part, basically all the value is captured by Rain and Reap. So, for example, when you're transacting with a Rain issued card, such as one, I know the Cleveland Cavaliers actually recently started issuing cards with Rain, but I guess a more obvious example is something like the EtherFi card. The EtherFi card uses Rain. And so what will happen there is, instead of having to go through a banking intermediary and having all this bank account stuff set up for you and having to go through all this KYC, KYB stuff with the bank, you actually do it directly with Rain. So Rain settles directly onto the Visa network instead of having to go through a bank, meaning when you're transacting with your card, it doesn't do all this, just going directly onto the Visa network through Rain. And you can choose to do it. Actually, the interesting thing with Rain, as opposed to Reap, is they actually have participation into Visa's pilot program that allows you to have native stablecoin settlement. And so what happens there is, instead of liquidating your stablecoins into fiat, you can actually just send stablecoins directly onto the Visa network, and that'll be sent to the merchant instead, which is actually really, really cool for a lot of different reasons. But that's sort of the world where I think we're moving towards for cards specifically.
Is it cool because it basically just removes transaction costs? Like, if you don't have to liquidate USDC, there's no market maker in the middle taking some spread when you liquidate your USDC for USDE. Is that basically the reason why?
Yeah, there's a lot of different reasons why I think it's quite cool, but that's one of the reasons. To be completely honest, like the sort of like black box that happens for how that works with a pilot program for Visa is a little bit unknown at the moment because it is so new. I'd have to look deeper into that, but I think that's probably the world we're going in, especially if what I think is true is if it does remove the tax event that happens when your crypto gets sold fiat. That actually I think is a really big unlock, because the reality is, even with cards right now, since most of them settle on fiat, the moment you transact with your MetaMask card or whatever card you're using, it actually triggers a tax event. And so a lot of these things end up being pretty annoying for some people. Maybe you use a crypto card as your new primary card. At the end of the year, you have to sift through thousands and thousands of little like micro tax events. That might be a little bit annoying.
Yeah, although in theory, if you're selling USDC or USDT, there should be very little capital gains on that. But if you're transacting with something else, then those would be a bunch of small capital gains events. Okay, cool. Why on earth would a consumer want to do this? Like, okay, we understand who some of the players in this space are: MetaMask, Rain, banks, Visa, MasterCard. These are a few that we've mentioned. It seems like a super complex thing. Why does the end user want to do this?
Yeah, it's a good question. I think that for now, most of the PMF for cards have been found in developing countries and emerging markets. So specifically regions like LATAM are actually very, very big users of these like crypto-linked or stablecoin-linked cards. And the reason they want to use these cards is because their local fiat currencies are in complete turmoil, right? They're completely crashing. It's extremely volatile. Most of these users or just residents in general of these countries don't want to hold their native fiat. And so they'll want to hold USDC and USDT. You'll see that a lot of the volume that comes with USDT, specifically on Tron, comes from these LATAM countries because the vast majority of their economy runs on stablecoins. And in order for them to use these stablecoins, there isn't really an easy way to do that. And cards ends up making it the most convenient way to do so. And you'll see that a lot of the volume growth in payments for stablecoins has been in cards and not in P2P, which implies to us that a lot of users aren't actually just sending their stablecoins directly to someone else's wallet. They'd much prefer to start using these cards.
Yeah, I want to talk about this chart because I looked at it and I immediately, the data guy in me immediately went. So what's the methodology behind this? How did you get this data to begin with?
Yeah, it's a good question. So this data comes from our early report back in August in stablecoin.fyi, but it's mostly off-chain data actually. So a lot of this data comes from our partners. So teams like Reap and Binance were able to provide us this data, and we were able to create some insights off of it. A lot of the data on-chain that you'll find actually for crypto cards is pretty limited. There's probably over 250, 260 cards in the universe of crypto cards, but very few of them are able to be tracked on-chain. And so most of the reliable data is off-chain.
Yeah, the ones that would be tracked on-chain would just be like the non-custodial ones, like the MetaMask and those, right? Like the other ones you can't really track on-chain.
That's right, yeah. Like the Binance card, for example, the Bybit card, these things are really hard to track on-chain. In fact, I would argue almost impossible. And so we need to partner with these data providers that can help us sort of have the most, comprehensive overview of the market.
Okay, and one of the things that, I know it's not the main topic because it's with regards to cards, but one of the things that I look at here is P2P payments seem to be actually going down since 2023, at least in stablecoins. Is the P2P side of things, is that coming via on-chain transactions, or how's that measured? Because I was a little bit perplexed by that, because obviously like stablecoin AUM, stablecoin inventory has exploded since 2023, and yet peer-to-peer payments seem to be going down. Obviously crypto card payments are going up, but on the other, it just doesn't seem to be, I don't know, it seems a little bit odd. Like, what's the basis of this?
Yeah, so the P2P data is, again, also a lot of it is from off-chain providers. One of the biggest things are, for example, like Binance Pay C2C. So people are using the Binance Pay C2C to pay each other with stable coins, things of the sort. But my personal hypothesis for why I think, P2P payments are generally pretty flat or even somewhat of a downward trend is primarily because they've already really found their PMF. Right? Like you'll see that a lot of P2P payments are things like remittances or things of the sort. And a lot of people that are reliant on stablecoins for remittances have been using them for a long time, right? People have been even using the Lightning Network back in the day on Bitcoin to send remittances cross-chain instead of relying on these like banks that takes like a T+3, T+4 settlement time, right? Like these things are really annoying for people that are working in the States, for example, and sending money back to Mexico or wherever it is. They've been using stablecoins for a long time. And so the most interesting, I guess, industry that's been skyrocketing with stablecoins in the past 2 years has been cards, which is because it's, I guess, attacking a new market vector that hasn't really existed up until very recently.
Okay, so this also kind of tells you a little bit about consumer behavior, right? Because if you're not using it for P2P and you're using it for cards, it means like, it's kind of showing a different use case, right? It's going from this like remittance use case or like money stash use case to actually like becoming slowly your day-to-day spending account, right? Like cards have a much higher frequency than P2P payments, if you think about it, right? Like P2P payments, when's the last time, like you'll pay your friend after like dinner or something if someone else pays. Not super often, but cards you pretty much use every day, right?
Right, exactly. And I think the reason why, removing crypto from the conversation here, just why do people use cards in general? I mean, there's so many benefits, right? For credit cards, there's unsecured credit, so you don't have to put up collateral to use your credit card. You just sort of pay it off at the end of the month. Things like that. But you also, have these like rewards programs and points programs that are very, very enticing for users. And I think these things are actually what makes cards the most interesting. And the crypto card specifically, there's a lot of like really cool points programs and rewards programs that are going on. For example, in the report, we found a pretty interesting data point that EtherFi actually pays more cash back than the highest threshold you can earn from centralized exchange cards, right? Because they have a near zero cash capital cost to issue out these cashback programs. I think the next unlock for these is actually probably going to be partnerships that makes these crypto cards equally as enticing as very large existing card programs that exist now in the status quo. So like with Amex and Chase, you have all these like really interesting points programs that allow you to have like airline points or use them at retail stores like Lululemon, wherever it is. Once these things sort of slowly start coming into the crypto space, I think this is probably what will bring the majority of retail non-crypto users into starting to use crypto cards.
Yeah, I think there's a few interesting points here. So these crypto cards, as you illustrate in the report, they're used for various different things. They're used by some people who are living in emerging markets with weak currencies as a way to have digital dollars that they can spend on a day-to-day basis because they can spend it everywhere because it's a MasterCard or Visa. But they're also used as a customer acquisition tool, right, for some of these centralized exchanges. And they're also used as a way to diversify revenue for something like MetaMask, which is a wallet that has very seasonal revenues based on whether the market's going up or down because it's mostly trading revenues. So, tell me a little bit more about this. What's the, because crypto cards are one thing, but the kind of like the purpose of them there seem to be very different purposes for them.
Yeah, definitely. In the report, I outlined 3 specific sort of categories or industries where crypto cards makes the most sense. And so for centralized exchanges, they're primarily used as customer acquisition tools. For Gemini specifically, they report with the SEC. There's a few different incentives there that exist for those, wallets. But we can go into those in a bit after looking into this graphic here a little bit more.
Yeah, I want to talk a little bit about this because it seems superficially like it shouldn't make sense, right? You launch a card program that you're continuously losing money on. What's the point? Well, you mentioned it. It's a great customer acquisition tool. It brings in lots of users. So, what is it about the Gemini card program that's so sexy that makes people want to use it?
Yeah, I think it's actually pretty interesting because Gemini, a centralized exchange where it offers up to 4% cash back on certain sectors that you spend the Gemini card on. But I think what makes it the most interesting is that you're able to choose what crypto you get your cash back in. It can be in Bitcoin, ETH, XRP, whatever it is. It sort of makes the customer feel like they have and they do actually have a lot of choice and ownership over how they're getting their cash back and what they're getting it in. So for a lot of users, it actually feels like an investment using this card, right? Instead of getting these sort of artificial Amex points or Chase points that you can use at retail stores or airlines, they actually feel like they're gaining investments, right? By holding XRP or Bitcoin or ETH or Sol, whatever it is, the more and more they spend their card. And so I think that's probably the main reason why so many new users are coming on to Gemini through the card program.
And there's also a little bit of lottery, right? Like you're shopping around while Bitcoin's at 10K or 20K or whatever, and then all of a sudden Bitcoin runs to 100. You're like, oh, I've gone from 5% cashback to 50% cashback. That's great. All right, that's pretty cool. And I know a little bit about. Okay, so where are the losses generated in this program? Because I know a little bit about the traditional credit card world, whereby you have two sides of the equation. You have credit losses, and you have losses in terms of the money that you lose due to non-performing credit. And then on the revenue side, you have interchange, and you have interest expenses. What's going on here with the Gemini card? Are they making money on interest? Are they losing money on interest? What's going on here?
Yeah, the majority of the reason why Gemini is actually losing money on the cards program is mostly because of the rewards and credit losses. So lots of unpaid balances, whatever it is. Gemini sort of, fronts this as part of their business and doesn't really care how much they lose on this, or I guess they do a little bit since they're not losing too much on the business through the cards program. But it's a cost they're willing to accept because it drives so much more revenue to the rest of the platform.
I would guess it's more the rewards than the credit card losses themselves, because I guess, aren't most of these positions collateralized, or do they actually give unsecured credit out for this program?
Yeah, it's mostly through the crypto rewards, but it does function sort of. I believe it functions as they partner with a bank to have unsecured credit, sort of similar to how Coinbase issues through Amex.
Got it. Okay, that's pretty cool. But in terms of rewards, that's not the highest rewarding one right now, right? Because you can get more by, I think it was the EtherFi one, because they pay out the reward, the cashback in their own token, right?
That's right. They pay it out through Scroll, which is the layer 2 network that the EtherFi card is issued on. And so for them, because they're just issuing a token as cashback that they get through a partnership with Scroll, instead of Gemini having to upfront, pay out these cashback rewards with crypto, for them, they can offer much more attractive cashback programs to their users. Naturally, of course, the EtherFi card has less users than the Gemini card, for sure. Mostly because it's a little bit more crypto native, like sort of DeFi focused for a lot of existing EtherFi users or very on-chain native users. But it's actually really, really interesting how much cashback they're able to issue back that practically no other card in existence is able to match.
Cool. So from this, it seems to me like there's kind of like two different types of main user base, right? You have the sort of rich country people where you use crypto cards as a way to acquire users or a way to give cool rewards and like boost TVL, etc. And then you have like the other side of the equation, which is like, developing countries actually need digital dollars to transact. Would that be a fair assessment?
Yeah, absolutely. Yeah, there's a lot of companies that are in the latter. So companies like Pay, Lemon, there's so many that exist in that sort of sector where their primary focus is on these emerging markets and developing countries where they make most of their revenue from interchange fees, card-related revenue, etc. So it's a pretty wide spectrum of incentives for launching a card program.
Yeah, I'm just trying to zoom in a little bit here. So we're looking at these three different providers. So it's Pay, EtherFi, Cast. This is the traffic share. And most of their traffic comes from places like Bangladesh, Pakistan, India. For Pay, for Cast, it's Nigeria, Saudi Arabia. And for EtherFi, it seems to be huge in Brazil. So I guess that would support your argument that it's, primarily a developing market. Although, I originally thought, okay, this is like EtherFi will be for like digitally, for DeFi people, but it seems like Brazil and the US and Denmark are the top ones. Maybe, Brazil, US, Denmark. I don't quite understand how the three of those add up together. Do you know what the story there is?
Yeah, Denmark there, I don't really have too good of an answer. But in terms of the US and Brazil, I think because Brazil is one of those countries that I mentioned earlier where a lot of their economy runs on stablecoins, a lot of the residents of Brazil and other LATAM countries have become like very, very crypto native over the past few years. And so I would actually categorize a lot of these users as DeFi native or at least like on-chain familiar users. So EtherFi, I think for them makes a lot of sense. It's a pretty straightforward process, right? You set up a wallet, you sign up for a card, you get your card, you spend, you get a lot of cash back. And they sell the Scroll tokens for, stable coins, and they're able to hold this as like a savings account or even like a spending account, whatever it is. But I would argue that a lot of these countries are relatively pretty on-chain native. Even in Africa, there's like Nigeria, South Africa, all these other countries are extremely, extremely, familiar with the crypto space because of their, general like macro or overall economy situations that are forcing them on-chain.
Yeah, and what's been like the biggest driver to growth in the sector in general? Because as we saw at the beginning, the chart, it's a straight up and to the right sort of chart. Like, why is this happening? Why now? Like, why are people all of a sudden interested in this? What's pushing the market forward?
Yeah, it's a good question. I think there's a lot of different ways you can sort of answer this question because there's so many different reasons that sort of compound. But I would probably argue the main reason that I think this is happening is because stablecoins are becoming more and more and more familiar with a lot of people. I think in the past 12 months, there's been over 300 million unique users of stablecoins, which is an absurdly high number. If you told this to someone 5 years ago, they would look you dead in the eyes and say, you're bullshitting me, like you're bluffing. But it's just going to grow exponentially from here for the next few years as well. And I think with more and more people being onboarded onto stablecoins, they want easy ways to spend these stablecoins. And cards, especially issued by Visa and MasterCard, are already hooked into the global network. Over 150 million merchants worldwide accept Visa and MasterCard. It makes a lot of sense, actually, for these cards to be taking off. So that would be my main argument.
Yeah, I mean, I spoke a few months ago now with, or maybe a year ago now, with the head of remote.com, which is a remote work company, and they had at the time launched stablecoin payouts, which is something that users were demanding. And I guess if you're getting paid via remote work, and you live in a place like Argentina, you live in a place like Brazil, you want to spend that money, you kind of need to have a crypto card to make it work. So it's maybe like sign of just stablecoin adoption growing in general significantly.
Yeah, exactly. There's a lot of people across the world that are starting to have a preference for being paid in stablecoins. And I think even in the US, we're slowly starting to see this sort of happen. There's a Minnesota credit union, for example, that just recently launched a stablecoin program under the ticker Cloud, I believe. And for them, their sort of thought process is a lot of their users want stablecoins and want access to these stablecoins and want to be able to pay out in these stable coins, right? There's also a lot of startups that are very quickly moving into this space. Slash comes to mind, Gusto comes to mind. So many of these startups are starting to integrate stable coins as real payment options for their employees, and people would need ways to spend these stable coins, right? And I think cards makes the most sense there.
Yeah, I think the U.S. market is a very interesting one because being familiar with the credit card market outside of the U.S., it's like two different universes, right? In the U.S., you have these super generous reward schemes where consumers are used to being paid loads of money to just transact, and that doesn't exist as much in the rest of the world. So how does that change the dynamic? Does that mean it's harder for crypto cards to be competitive, or actually just means that crypto cards in the US get to charge as much of a high interchange as all the other ones and they'll be just as competitive?
Yeah, it's a great question. And even in the report, I sort of argue that maybe the US is actually a market that should be looked deeper into for crypto cards because the Americas, including the US and Canada, are by far and away the biggest and the fastest growing, segment or region, I guess, in the world for credit card revenue. People are just using credit cards a lot in the US and in Canada. And I believe the number is just about 90 to 95% of all adults in the US have used or own a credit card. And people are just using credit cards more and more and more. And what's interesting is in the US specifically, people generally aren't super loyal to their credit card programs, right? There's a lot of churn with these credit cards. There's even these like subreddits that are being spun up or have been around for a long, long time rather, talking about like farming these credit card programs and churning different cards and like the optimal number of credit cards you should own for, to not affect your credit score, but also farm the most amount of points, right? There's a lot of these different discussions that happen that are interestingly pretty unique to the US. And I think that crypto cards, if they're able to sort of offer similar, rewards programs and points programs and maybe even benefits with stable coins for maybe, interest on your unused capital, which maybe might get affected by the new market structure bill that's been introduced just a few days ago. We'll see how that sort of pans out. But there's a lot of, I think, really unique opportunities for crypto cards to thrive in the US alongside the major players, or maybe the major players like Amex and JP Morgan Chase and Capital One, maybe they start integrating stablecoins into their programs, which would be really interesting to see.
Yeah, I think there's from the rewards perspective, there's kind of two very interesting angles that could potentially work in the US. one of the angles is what's happening with EtherFi, where basically your cost of rewards is effectively zero because you use a native token, which could potentially be a very fun way to bootstrap a massive user base. And I think the other one is this like aspect of giving people rewards in the cryptocurrency / asset of their choice. Could be a very fun thing to do. Like if you project it out to a world where stocks are tokenized, there's no reason why you shouldn't be able to get Tesla shares as cashback or whatever, SpaceX shares or whatever the latest hottest stock is.
Yeah, exactly. And you can even maybe use these as collateral as like effective credit, right? A lot like for EtherFi, I think their most interesting offering is actually EtherFi Cash Borrow Mode, which allows you to take loans against the crypto that you hold in your EtherFi wallet or the pools that you've dedicated your assets to. And so instead of having to sell this crypto, like maybe this wrapped ETH or whatever it is that you're holding in EtherFi in like pools, you can actually just take a loan against that collateral and spend that as effective credit, right? And once we get into the world of like tokenization of a bunch of different things, then you can maybe even use your stocks as collateral, like many ultra high net worth individuals do, or maybe even long way into the future where you can have tokenized NFTs of your mortgage, for example. Maybe you can even use that, right? There's so many different ways you can sort of think about this and spin this, but I think there's a lot of interesting things that'll be happening over the next 10 years.
Yeah, I want to talk a little bit more about that because I think that's a super interesting area. There's the current, if we look at the US, the current credit card model is I have a credit score, I apply for a credit card, they give me some sort of eligibility check of whether I'm allowed to take this credit limit, yes, no. If I say yes, then they, if they decide that yes, they can lend me this money, then they'll give me a credit limit, and then depending on how I pay off the credit that I get every month, if I pay it off regularly, then I'm just like a simple transactor. But if I actually keep a balance on it, then they categorize me as a revolver. I pay 30% APR on that. That makes tremendous amounts of money for the issuing company. That's a standard model, and I think that's kind of where the industry is right now for the US issued ones. I'm very interested in like these different models that you mentioned. So I know there's a startup looking at taking your home equity and putting it on a credit card. I think that doesn't really touch crypto rails as of right now, but I think that's a very interesting one. But you mentioned the other ones, right? Like your brokerage / your crypto assets. Like there's no reason why you shouldn't be able to borrow against those. And if anything, you shouldn't have to pay 30% APR because they can liquidate you immediately. There's zero credit risk, right? So which ones are the most advanced from that perspective? Is it the EtherFi card?
Exactly. Yeah, EtherFi is for sure the most popular for that. There are a few other companies that are working in this space, but EtherFi is by far and away the most popular and the most used of that segment. And I think that actually is, in my opinion at least, like probably the first step towards bringing credit on chain, right? This sort of works the same way for a lot of other like private credit offerings on chain. But I actually think the most interesting sort of next evolution of credit cards in crypto will be unsecured credit, like those credit score based credit cards that gives you like some limit on your card. I think bringing these things on chain somehow, exactly how you design that would probably take a little bit more thinking. But the unsecured credit is by far and away one of the biggest markets, especially in the US. That's the reason why Amex, why JP Morgan Chase, why Capital One, why all these big card issuers make so much money every year. It's because of unsecured credit.
Yeah. And I think on the unsecured credit side, there's a few ways in which you can do it. Like one of them is, okay, you pair your crypto identity with your real identity and you take your credit score, you merge these two together, and then you basically It's the same thing. It's the same credit card, same credit score, but on crypto rails. That's one way of doing it. The other way of doing it is somehow looking at your public transaction history and using that as proof of credit. There's been a lot of talk about doing that. I don't know to what extent that's feasible. And then I guess the third one is using kind of like more like not necessarily secured by assets, but by like digital goods. There's a very interesting company based in San Francisco I spoke to last year, which what they do is they put some software on your phone, and if you don't pay for your loan, you basically just can't use your phone anymore, right? It's kind of like you ran out of credit on your phone. So I think there's like some future in these. How are you thinking about this market?
Yeah, it's super interesting. I think a lot of the sort of like market design or like mechanism design principles you can throw into this varies quite a lot. And I'd be lying if I said I had the answer to how we bring unsecured credit on chain. It's a hard problem that I know a few companies are trying to solve right now. And if I had to bet, I think a lot of these will probably happen on a very few number of chains that sort of specialize in these stable coins, like Ethereum, obviously, right, a few layer twos, but I think Tempo, that'll probably end up being the like breeding grounds for new stablecoin use cases or just new primitives in stablecoins. I actually think Tempo will probably be the place that it happens.
I'm actually chatting to Brian, the CEO of Stables, next week. What should I know about Stables? How are they doing in the crypto card market?
I don't believe so. They're not live on public mainnet yet, and so I believe just on private mainnet at the moment. So we'll see how Tempo sort of evolves. They've already, they have all the connections because of the, partnership with Stripe. They already have all the connections with many of the biggest companies and banks in the world, right? I'd be surprised if it happens anywhere else.
Yeah.
I know Plasma also issued cards with Rain, and Plasma is another stablecoin focused L1. Stables is another one that's like a stablecoin focused L1, right? But Tempo, I think, has this so much momentum behind them that I think Tempo is probably the place that'll attract the most talent and the most innovative use cases.
Well, I think the interesting thing about Stables as well is like Plasma is very much associated with USDC, I believe. Stables, on the other hand, is backed by Tether, and Tether is the market dominant stablecoin. But nevertheless, in the crypto card space, it seems like there's some avenues in which they're kind of locked out of.
Yeah, Stables I actually haven't heard too much about in terms of the crypto card market. Plasma is the first stablecoin focused L1 that I believe is issuing cards natively with Plasma 1 on Rain. And I'd be surprised if most of these stablecoin focused chains aren't planning on doing the same. If Stables doesn't have this in their roadmap, I definitely think they should. And there's so many of these being spun up now. I'm sort of curious to see how the landscape builds out over the next few years, whether it's like a Stripe and Paradigm win or whether it's a DeFi native win with Plasma and Stables. We'll sort of see. But to be honest, I sort of lean towards the former.
AUM, exactly. Account, which means they're not necessarily transacting on a day-to-day basis with it. I want to talk a little bit, one last question. I want to talk a little bit about the duopoly of not Tether and USDC, but rather the duopoly of Visa and MasterCard. I just wanted to share this chart. MasterCard is absolutely being dominated by Visa in terms of volume. They have a similar amount of programs, as you mentioned in your report, but it looks like Visa is just doing a lot better than MasterCard in terms of market share.
Yeah, USDC is actually the primary stablecoin by a very, very large margin for like Rain card deposits, which obviously Rain cards are some of the biggest on the market, if not the biggest alongside Reap, right? USDC has the benefit of being natively on the VisaNet and the MasterCard network, where it's able to settle in USDC alongside a few others like PiUSD, FIUSD, EURC, which is the European stablecoin issued by Circle, right? Tether is currently not part of this program, but that doesn't mean they're locked out of crypto cards entirely. They still are the primary stablecoin used in LATAM, used in a lot of different regions, especially like APAC, for example. And so Tether is still very much a player in the stablecoin linked card space, but Circle and USDC definitely has their foot in the door much quicker and at a much larger scale at the moment. And I think we'll see how the cards industry sort of impacts the Tether market dominance over the next few years. Maybe it'll consolidate, maybe it won't. But I think it'll be really, really interesting.
Cool. Okay, that makes sense. I was gonna give Visa the props for quickly identifying and absolutely dominating the market segment, but it sounds like there's a little bit more nuance to it. Okay, Patrick. So by the end of 2026, we're recording this at the beginning of the year. End of 2026, how do you expect the crypto card network, card payments industry to develop?
Yeah, that's right. And I think there's actually a little bit of a caveat to this. The graphic itself is only for on-chain data. So effectively, most of this comes from data from Rain and Reap, right? Because Rain and Reap are Visa principal members. But a lot of this excludes the MasterCard volume that is done on Binance cards, on Bybit cards, these cards that aren't able to be tracked on-chain, which Binance obviously has the largest user base out of any exchange in the world, and they likely have a significant chunk of the card's volume. So in reality, I think this is actually much closer than what it seems, but Visa is definitely often running away with all of the on-chain issuing with Rain, with Reap, with a bunch of these other partners that they have. So we'll see how it plays out in the next few years, but I think they just have different sort of like, I guess you would call strategies in the card space. Bullish. And despite how maybe unsexy cards are in terms of like a design perspective, like, oh, it's just a sort of card that hooks into existing like legacy payment networks like Visa and MasterCard, reality is the world that we've been living in for crypto for the past few years has been a lot of these quote unquote unsexy use cases, right? Like bringing private credit on chain, bringing equities on chain, bringing cards on chain, right? And these are the things that I think will probably continue to skyrocket. And I think cards will likely be the number one retail payment use case for stablecoins by the end of this year.
Cool. All right, Patrick, thank you very much for your time. Is there anything else that you want to add to this conversation?
Yeah, just one last thing is we're looking into adding a lot of these cards and payments things onto the Artemis terminal and our product suite in general. And so if anyone is interested in sort of working together with us on getting their stablecoins or products up and running on the Artemis terminal, or just interested in chatting in general as a user, please feel free to reach out to me or to the team, and we'll do our best to get something working.
Mehler, the CEO of Stable XYZ. Is it a Dubai-based company? What do you guys advertise yourselves as? All right, so I welcome Brian Mehler, from the CEO of Stable, a relatively new stablecoin business that has attracted a lot of high-profile investors in the last year. Brian, you've been around in the crypto industry for a while. Can you give us a little bit of information about your background?
Yeah, so you're definitely right in terms of how things have changed over the past nearly decade. It definitely feels like that was more recent, but I would say like where things are going is that the technology has proven itself. I think that was a big holdback at the beginning, was that a lot of times it was the underlying technology was getting overlooked or overshadowed by a lot of the noise or the hype in the space. And I think that really distracted from like the quality of the services that the technology could provide. And I think now, it's been a few years since I've been in the industry, and I've seen kind of that change and that shift, where now major banks are using technology for internal systems because they understand like the speed and the processing and also the auditability that comes from using, a blockchain technology. And I think that's what's coming, definitely to the wider market now, that the technology's been proven. There's not a question there anymore. It's secure and it's safe, and it's something that can scale. And now it's going to be put into like, what are the real world use cases that actually come to market and then become sticky? So I would say like where it's going, I would say, retail usage adoption, and also, interbanking and corresponding banking is kind of where it's going to take off, I believe.
Yeah, I mean, I think this is one of the things that we discussed pre-interview. Like, I've been following crypto since 2018-ish, roughly. And a lot of the situations, a lot of the achievements and milestones we've hit so far in 2026 seem like a distant dream looking at it from 2018. I think it's very often easy to lose track, forget the fact that we've come a very long way in these last few years. And I think particularly with regards to stablecoins, we're in a very interesting place. Where do you see the market going?
I mean, I think there's a little bit of both in terms of obviously one has to lead the other. I would say if the technology wasn't working and you didn't have support of banks or financial institutions wanting to use it, I don't think there would then be the effort to get it in proper legislations or get it regulated. I think that would be pretty much dead in the water or a non-starter. So I would say technology definitely had to prove itself. And that's evident, as I mentioned, the banks getting into this, you have the JPM coin rolling out on new use cases. So they obviously like it. And I can't speak for what they're doing in internal conversations, but obviously they're using a blockchain to deliver the JPM coin, interoperability for themselves.
And you mentioned technology has proven itself. Is it the technology that has proven itself with regards to crypto and stablecoins, or is it more of a regulatory angle where serious players are now looking at this and saying, actually, this is not going to go away, regulators not going to ban this, so we might as well start using it?
I would say it's a good question. Definitely one of our areas of focus. I would say there's kind of a three-prong approach that we're doing in terms of addressing the different markets, kind of hitting it all full on. So there's obviously the retail side, there's the institutional side, and then there's the chain native side where, that's a general developer or team coming together, one use a better product in their toolkit. But for the institutional side, I would say there's a myriad of different uses. I would something like JPM where it's permissioned and it's a closed network. That's obviously a different wheelhouse of what they're choosing and why they're choosing technologies. But for the institutional side that we are working on a lot of adoption with, that's a lot of the corresponding side of banking, and then also the scale and the reach of payments, because the fragmentation that's happened in terms of we can talk about Swift or ACH or even Fedwire and all those different tools, it's the incentives are misaligned and the parties are not actually in a proper alignment. And I think that's a unique thing that involves payments. I weirdly spend a lot of time in payments, maybe because my mom working in a currency desk, but growing up in the 80s. So hearing how bad that technology was and her stories of having to pick up the phone that was locked in a room to call London when transfers were done, we're not far off from that now. We're still confirming transfers are made and it's still slow, and a SWIFT, internationally can take seconds or can take days. And that's a weird part that I think we all look at the embracement of AI and the speed and how fast your 5G needs to be, but then we're totally okay for some weird, strange reason that payments go extremely slow and are extremely expensive. And I think that's something that needs to be addressed.
Yeah. So talking about JPM coin, is that where you see most of the new demand coming for stable coins? Is it coming from the institutional side? Is that where you guys are trying to service at Stable?
It's 100% how I see it. I think the experience of having to send wires domestically, or what you feel is domestically, but it really hits an international bank. I've had, at Stable, many of the similar experiences, and it's always very funny, trying to find out where a wire is or something that we had to pay, whether it's a legal fee or, paying for a service. And the odd part is when I get on the phone with the vendor who is trying to receive the payment, they always ask oh, well, what do you do? What's your, what type of business are you guys in? And I'm always well, I'm in the payment space and I'm working in digitized payments. And it's a usually pretty funny conversation when I get on the phone with banks and they're doing the KYC check, which they should do. But it's always very funny when they hear, oh, how do your payments work? And I'm a lot better than this situation. So it's always a fun introduction.
I mean, listen, I had to get, my company issued an invoice it was a US-based company, and I issued an invoice that I had to get paid from Hong Kong. And the difficulties I had trying to do that. So here in the US, I have a Mercure account, which is general startup bank account, and Hong Kong-based bank just refused to pay it. In the end, the only way I could make the transaction was issue a Stripe invoice. I lost a good percentage, I think more than 3%, almost 5% of the transaction, because it was a foreign card, obviously, to the transaction cost. So I'm very familiar with the difficulties as of right now of payments. One of the criticisms is that of the current payments architecture is that we've taken all of the systems that your mom used back in the 80s, and instead of coming up with something modern and new, what we've done is just digitalize them. So we're still, doing the equivalent of calling someone in London, but instead it's just, some API script or someone downloading a big spreadsheet and uploading it somewhere else. Is that how you see it?
Yeah, I mean, I think the idea of a stablecoin came well after the idea of using a blockchain. So obviously there was, you have the Bitcoin, you have Ethereum, and you have other chains that came into play. And I don't think any of them had the singular focus of moving payments in a stablecoin sense as quickly as possible. Obviously there was the transfer of value being taken place, but there really wasn't the idea of instantaneous payments with all the other noise that's on a network. And I think that's a sacrifice. So if people are making the change to use a blockchain for payments and trying to get speed or accuracy or visualizing where that money currently sits on the network, I think the oddity would then to be not using the best software. So it's using a general purpose blockchain isn't actually delivering the full promise when it comes to using blockchain or the speed of it. And that's one of the things that I have a lot of times when I'm working with whether it's friends who want to know what I'm doing in business. Obviously, it's been kind of a long time now since 2018, friends in the finance world asking when I left private equity, like, oh, well, what are you doing now? And trying to explain it to them. Now, the funny part is that they come to me telling me how they're using whatever feature it is at their company. And the long of that is when I try to get them to use one of the networks prior to us launching, it was always a complication, whether it was a complicated gas token or the volatility of that token or having to need a second token. And they're like, well, this is good in idea, Brian, but there's a lot of asterisks. And I say my kind of mission for Stable is removing all those asterisks. So if you want to send me $100, send me $100. You don't need to send me $100 plus some dust in a native gas token. And if you're figuring that you're going to spend $20 on that native gas token, and that should get you, let's say 20 transfers, but then the market crashes, now you have 10 transfers, or the transfers become twice as expensive. So removing all those asterisks, I think, is really what's going to get the adoption to grow.
Yeah, I think that's probably one of the best features of blockchain-based payments is that you can see exactly where the transaction is at all times. I understand that you guys are, however, building a payment-specific blockchain tool because although with, let's say, an Ethereum transaction, you can see exactly where the payment is at all times. The argument is that Ethereum actually wasn't really built natively to support payments. Is that true?
Yeah. I feel that both of those applications are important. That's what we do at Stable. When we have the retail side, we've abstracted out all that complication. That mobile app of StablePay launches early Q1 of this year. And that's one thing we're excited about. That's really going to help with the onboarding of the retail client, or maybe someone who's familiar with USDT or USDC or PYUSD, but is kind of apprehensive because it looks a little scary. And I think that's part of that abstraction that you're talking about when it comes to using a blockchain service. When you tell someone, well, here's your wallet, put all your money on here. How do you connect it? What's that situation? That gets really scary, and it's hard to make the jump from a safe bank that may not have the best tools, or it may be a little expensive or charge you a monthly fee, but at least you know where it is and how to use it. And so with a non-custodial wallet and StablePay, it makes it, you just send in someone's name, phone number, the account, and you see the balance. You don't have to worry about the gas fees, and you don't have to see that complication. And I think that's kind of what you're talking about, the abstraction on a general purpose chain. And I think that's great. But I still believe that there's the slowness there. And that's where we look at the velocity of the money in terms of if you're trying to get money to move faster. Let's say right now, I move money on, let's say, the Ethereum network on a regular basis, pay invoices in USDC, USDT. And when those invoices, it's a lot of back and forth checking. You mentioned using Mercury. We have a great partner that we work with at Meow Bank and, love their services and they're great, but it's still a wait to get that transaction hash to then copy, paste, and send it over. And so if the network's slow, I know right now there was some volatility. Dakota Bank, for example, they have great features built in with Bridge, but there is still a business process that's in place where there still is a cost for those fees, and those have to be absorbed somewhere. They're not extracted; they are still there. but based on a business model you can work around or work with. But when the fees become too high or the spread becomes too large, things slow down. And that's, again, what we're trying to remove. So I'd say a purpose-built system such as Stable that we're building solves all those issues. Again, removing asterisks that are surprises when you don't want them.
Let's abstract all of the nasty stuff, the gas fees, all of this. Let's abstract it away from the user. And we've seen a few attempts at doing that, both on the B2C side and the B2B side. On the B2C side, you see apps like Base from Coinbase or FOMO, which just abstract the whole gas thing away. And on the B2B side, well, last year I spoke to Ed at Zero Hash. There's also, Bridge, which was acquired by Stable. There's this idea of like, okay, let's abstract it away, let's create an orchestration layer, and it doesn't even matter which blockchain we're going to use. Let's make it simple for the end user to just, send the stablecoin here, and then it's done. Why do you think the purpose-built blockchain is going to win over the abstract away complexity for the user use case?
Yeah. So 2026, having launched at the very end of 2025, is really focused on kind of going back to those three pillars of like approaches we're doing. It's the institutional side. We're working with a lot of financial institutions and banks right now, getting pilot programs underway, and definitely figuring out what that toolkit that they want to deploy looks like and how they can use a better, cheaper and faster network. So that's like the velocity money type of client we're looking for. And then on the far other side, for that retail client, that's where we're launching that stable pay app, because that's kind of broken into the go-to-market for that is focusing on individuals who are already using stables. So they regularly transact. They're, they're ambivalent to the network. They're not beholden. They know the network's not working for them. They're not looking, they just move money back and forth, whether it's remittance or cross-border payments. And here's an option that, EVM compatible, so same wallet addresses, move it over a different network, and you get it at a much more predictable time and price and cost, whether you're using the stable pay app or going native on chain. So that's one that we feel is kind of the first shoe to fall that we're working on. Those are people who just are tired of paying for expensive, slow networks. And then I'd say, in addition to that, we're focusing on, working with, our backing from Bitfinex and working with the USDT Zero team, and then working with Tether itself. That's really focusing on getting more people, or spreading the mission of Tether to more people to adopt USDT in a global sense, because people do want that exposure to the US dollar. People do want to have, fast transactions. And this is going to make that possible, where they can put something in a user's hand and be using it instantly without, bricking a wallet, without having a gas token and figuring out how to do that. So it's a mission that we're excited for, and we've already started halfway through January getting that done.
Tell me a little bit about your go-to-market. Who are you going to be targeting for your products? Like, how do you see your expansion in 2026? Are you looking for certain geographics, certain type of industry segment? Like, what's your strategy here?
I would say that we're also we're complementary to those solutions. So when they're abstracting out the cost to make it, a cheaper, faster network, we want to be that rails that they run on. So I would say not necessarily a competitor in all those markets. It's a lot more the tool that they need in order to achieve those goals.
Yeah, I want to quiz you a little bit on the B2B side, but before that, on the B2C side. Last year, I spoke to Edward, who is the CEO of Ubit, which is also another Bitfinex/Tether investment in Brazil. They also offer a service of effectively what I like to call like non-custodial neo-banking. It's an app where you can do payments, receive stablecoins, gas is abstracted away. Last year, I also spoke to Mike Hudak, the former Chief Product Officer of Monzo. He has a company called Sling, which is a very similar thing. They're more focused on the African markets. Both of these companies have been around for a while. What do you think you guys offer that these companies don't?
I would say it's a number of complications. As you said, like that technology or that system has been in place for many, many decades, and it's very hard to make the leap instantly. What we're looking for are some pilot programs that basically are, let's say, a closed ring. So corresponding bank means whether it's interbanking operations, so between one bank and its other, to simulate or to apply those transfers internally with the bank, and then also in smaller geographies or smaller jurisdictions and regions where the regulations are permitting certain corresponding banking activities. So those are things that we're working on in pilot programs to see. We know the technology works and they know the technology works. They need to see how many of their systems need to be updated or built or changed to make sure that they can plug into this network. So right now, as you mentioned earlier, when it looks like you're doing a transfer online, but it's really just making a PDF and sending it to someone else who has to manually type it in or extract it with a language, an OCR or something. It's those touch points all have to be reviewed and changed, because to make something simpler, in a sense, or to make something more simple, you actually have to remove a lot of complications. So that's kind of the program right now, is how do you remove all the layers of unnecessary handing things over and put all those tools or all those agents groups that need to look at a data into one new repository. So that's kind of it's a longer build out than you would imagine, because you're not having to just rip it out and here's your new toolkit. You have to replace every single touch. So whether it's the customer side, where the transfers, or the bank, where the audit, you now have to point to new directions. It's a one-time build, but they definitely see the value in it after doing it.
Understand. So like at some point you will be reaching out to companies like this and say, hey, like you guys are currently subsidizing Solana payments by this much per year, or whatever payments by this much per year. Why don't you use our infrastructure instead, and you don't have to pay that whole cost that you do, that scales exponentially as your user base does. Is that the pitch? Got it. Okay, so obviously this will work a lot better if you have a lot of businesses also connected to the network, because the bigger the network effects, the better it is for the network. So what are you guys thinking about on the B2B side? You mentioned correspondent banks. That's a topic that I've always found super fascinating, because I mean, the current system whereby everyone's got a correspondent bank account with JP Morgan in New York and they rely on that to pay everywhere else in the world is possibly not the most efficient system in the world. What are you guys looking at there?
We like to operate, respecting our partners and the privacy that they ask for, because I know it's a big build for them. And, I'd say I can't give you the detailed color on who we're working with and ideas like that. But I would say a lot of the pilot programs I'm working on, again, are focusing on legacy infrastructure, and that legacy infrastructure usually does not belong to the partner we're working with. So they have been forced to use a network or service, and it's costly to them. And for them to improve their margins is, how do you rip out those other services? So that's kind of an extra leg of work we're doing.
Can you tell me a little bit more about you mentioned pilot programs. Can you tell me, is there any information that you can share publicly around these? Because I can see amongst your investors, there's a lot of well-known names. So I'm kind of curious, how these pilot programs are progressing.
Yeah, I would say the difference in this, obviously, I believe, I eat my own dog food. We try to put our payments on our network and try to make our vendor payments in crypto. That kind of shows that we're really applying what we're doing. I think the difference now is how widespread it is. So the adoption has already kind of gone through, like in the natural adoption curve, it's already towards the center. So we know that we're climbing towards the peak where it's not new or fringe anymore. So I think the stickiness is basically built in, because it's very hard, if you look at someone who's currently moving money on crypto, to then go back and pay exorbitant fees trying to move money through a bank account. So as you mentioned, you have a US startup, you're going to make the payments there. You have that frustration, whether you're paying Stripe fees or you're paying bank fees, or can't make the bank move the money the way you want to. Once you kind of see that there's an option out there, it's really hard to put that genie back in the bottle. I think it's pretty much out, that they know there's a better solution, and I think it's going to stick that way.
If you've been around in crypto for as long as you have, you've seen a lot of these pilot programs come and go. Lots of big major banks announce that they're going to explore blockchain, and then the crypto hype dies down, and all of a sudden these programs are silently axed. Do you think this time's different for real?
Yeah, we work a lot with on and on ramps, and so to facilitate those types of interchanges. So you obviously have to figure out where that demand exists from. currency A to currency B, let's say there's a very low activity that currently happens, as the example you mentioned. Those are the situations that we're working on helping develop. So figuring out where those are, targeting them, developing them, and then once they start growing, they continue to grow. Because in reality, what had always happened was that they were moving out of whatever their native currency was and was just denominating everything in a foreign currency, and someone was eating that FX. So whether they want to stay in USDT by using a US stablecoin or USD backed stablecoin, that's one solution. But also they want to operate a lot in their native currency for situations where they have to then, let's say they're just a middle person, they got to pay it right back out. And that's where we're looking for creative solutions on our chain to do that, to those conversions and help with that FX risk that's taken on.
I spoke last year to one of the major stablecoin market makers, and he told me that they expect to see most of their market making demand in general come from stablecoins in 2026. And he mentioned a few use cases. I'm curious if you're also seeing these. So one of the ones that he mentioned was sort of cross-border import-export transactions between, say Thailand and Indonesia, right? They have possibly not that many corridors. Their FX corridors are just not that frequented. So for them to make these transactions very hard. So what they're actually doing is they're swapping into stable coins and from there moving into the local currencies. Is this something that you're hearing about in the market that is a growing use case?
It would be that case. So as the demand is, right now people are using demand are using another token or another currency because there just is very low volume. As that currency develops, they're more likely to stay in it.
So if that's for a company that wants to be able to swap in and out of the native currency fairly quickly?
I definitely think so. So I'd say prediction markets are very uniquely positioned, given that they're usually dollar denominated, single dollar for the transactions, the payouts, you're getting your portion of the dollar. I think that's a very easy use case for them. And I know there's already been a lot of work in that arena just because with a smart contract, it's very easy to control and apply those transactions. So I definitely say prediction markets are getting a lot of attention in the stable market space.
No liquidity on their side. Yes, got it. Understood. The other thing that I've heard in the market is actually prediction markets are bringing in a tremendous amount of demand. In fact, now that I think of the Football World Cup coming online later this year in June, do you think that could be a driver of stablecoin demand?
Well, so just getting this year started, I haven't had the moment to rest and actually think about what's going to happen at the end of the year, but I'd say the new milestones in terms of getting new number of total transactions per year is going to hit like another round number. Same thing for total AUM or total assets under management across the whole stable coin field. That's just a natural progression. I think that we're seeing the compounding growth that's occurring just because you have players like, again, PYUSD is a growing token. It's baked into the PayPal app. It's easy to send cross-border. Becomes a no-brainer effectively when you have a user who wants to send money to someone and you're in the app. Why pay the fee when you can send it for free? So I would say it's going to keep reaching new milestones pretty quickly. And then for a prediction to be really bold, I would say you're going to start getting a notable government to start taking, let's say, some sort of fees, whether it's in their municipality office or more of a state legislature or state office. You're going to have them taking stable coins because I think for them, it's much easier than receiving, let's say in the US, paper checks. So right now, the US receives a lot of paper checks for a lot of business, which is high risk, low performance, and expensive. But I wouldn't be surprised that there's already been some steps forward with, let's say, Bitcoin and some of the municipalities. I wouldn't be surprised if stablecoins become a tender that is accepted for paying invoices and bills. I would say that's a bolder prediction.
Interesting. Okay. So any predictions that you have for 2026 with regards to how the market's going to develop, stablecoin market cap? What should we know about what the end of the year is going to look like?
I think with something like USAT, you do have the opportunity where they put out regulation framework under the Genius Act. It's being applied and it's able to be followed. I think that's going to be a market that's opened up where if you have a compliant token and it's able to be accepted, it would be very odd if you still want to accept paper checks, which we all know can be forged, stolen, and all those things, versus why not get a payment instantly in a stablecoin? So there may be more of an integration layer, something like Bridge coming in while you're still paying or deduction there, the money's still moving. There may be, some layering that goes on it, but I think there will be a mechanism to start paying more for those fees, just because I know that I don't have paper checks anymore, but I still know when you fill out your US taxes and you want to send by mail, it's still, you can write in your account number, or you can pay online or send a paper check, which it still is wild that that's an option.
That's interesting, and that is pretty bold, because people generally think of stablecoin demand coming from countries with weak underlying currencies. People want to get out of the Argentine peso, and instead they want to hold dollars. Do you think that the U.S. with its relatively old-fashioned payment system, now that the regulation has changed, do you think the U.S. is actually going to become one of the biggest adopters of stablecoins in 2026? That would be a surprise.
I would say, in a more of like a evangelical sense, the idea of like actually using stablecoins, I think it's something that a lot of people are afraid to do. And I would say the surprise is actually the implementation of it, where you use a network that's fast and it's inexpensive. I think that's something that I think it's great when people encourage it. The odd part is that it's not actually encouraged enough. People are just going to default to what they know, like paying in paper checks. So I'd say, whether you have someone on later on another interview and you actually demo whether it's our app or someone else's app, I think that's a great way to actually show how quick it is, versus you can at the same time use a Venmo, for example, or another Cash App, but that money isn't in your account. That's still in their account. That's not money in yours. So I would say those are just interesting things to kind of push in the narrative.
I've been waiting for a JP Morgan check for the last month or so. So, I recently moved to the US, so the checks hit me as a surprise, but they're very much alive.
Definitely. One random kind of anecdote for this. We talked about credit cards. I would say again how banking infrastructure and credit cards is a unique part of that, where it's the only mechanism that I can think of that does not follow economies of scale. So as credit cards are now larger and larger, obviously more than a supermajority of the amount of transactions being done, let's say in the US, the oddity is that the fees still increase. So as now having done that payment, you got hit with that fee, foreign transaction fee, and it just weirdly just lines up on your invoice that you get. And let's say you received $1,000, it's magically not when you get it deposited. I would say that broken economies of scale is what is going to be addressed, I think, the most at the forefront of things, because there's no reason that you still have fraud on credit cards, but you're still paying high transaction fees. And I think that's where people are really getting frustrated. So I think merchants and vendors are looking for alternatives to getting taking the hit when it comes to credit card fees.
Okay. All right. Any wrapping up thoughts? We've spoken about your go-to-market strategy, your outlook for 2026, the strategy with both B2C and B2B clients. Is there anything else you'd like to highlight?
So I think there's going to be, for the credit cards, I think there's going to be several different types of approaches. Obviously, it has to do with how the payment provider at the processing the transaction works. So that's where we work with a large number of payment providers, payment service providers, to figure out what that looks like. I think whether it's a card that has your access to your cryptos and it's doing the moving for you, so like a payer account that takes place, I think that is one way to solve a lot of the fraud. But obviously, the card then doesn't have permissions on it, so that's still susceptible to the typical credit transaction or credit card transaction vulnerabilities. I would say it's more for like an online payment or a card that's locked into, let's say, like a QR code or an Apple Pay system, but that it's a little bit more protected. But I think magnetic stripes or printed card numbers are really not the way that credit cards should be working in the day that everyone is using modern technology. I think that's a little scary and highly risky.
Yeah, I mean, I think the complexity of these things does eventually just go away, right? Because back in 2018, 2019, taking a stablecoin payment, the gas fees would be all over the place every now and then. depending on what's the latest crypto kitty, and it would cost you $50 to send $100, and things would get pretty weird sometimes. I think now, even with the non-purpose built blockchain architecture, getting a stablecoin transaction is fairly easy. What's becoming a little bit hard, and I think, the friction that you still get is, for example, if I as a business want to take stablecoins, like, oh, how's that going to plug into my accounting software? Like, does that mean I have to then sell it? And is that a taxable transaction, et cetera, et cetera? But I think you mentioned something super interesting, which is once this is something that you're using, there's just no way for you to go back to stop using it. So I think, that's a very valuable property of the network. So as people get on-ramped into stablecoins, and as people own more and more stablecoins, or get paid in stablecoins, I think this is going to become more and more prevalent, that people just ask, hey, would you rather not get this as a stablecoin instead, and then the transaction can just go through. If you have a minute, I actually want to ask you about that, because one of the big trends of 2025 was this phenomenal growth in crypto cards, where you either have a custodial or non-custodial model, where crypto effectively in your account or under your custody gets turned into something that you can spend on the Visa or the MasterCard network. Do you think that's the trend that's going to continue, or is it going to move in parallel to that? Yeah, credit card technology was definitely not made for online payments. Let's put it that way. Okay, Brian, I'm respectful of your time. Thank you very much for your time. It's been a pleasure.